Microeconomics for Investors. Chapter 6, Cost Structures. Section 1, Fixed versus Variable Costs. To understand a business, you have to understand how its costs behave when sales change. Some costs barely move in the short run, while others rise almost immediately as output increases. That distinction affects pricing, budgeting, cash flow planning, and ultimately profitability. It also helps explain why two companies with similar revenue can have very different earnings patterns. For investors, cost behavior is one of the clearest links between sales growth and profit growth. It sets up the core distinction for this section: fixed costs and variable costs. Fixed costs stay the same in total over a given period, as long as the firm stays within its normal operating range. If a company produces a little more or a little less, its rent, insurance, lease payments, and many salaried roles usually do not change right away. A factory paying $20,000 a month in rent still pays that amount, whether it runs one shift or two, at least for a while. That is why fixed costs are called fixed in total, not fixed forever. If the company expands enough to need another building or another layer of staff, fixed costs can jump to a higher level. So the important phrase is within the relevant range. Variable costs move with production or sales volume. When a company makes more units, it usually needs more raw materials, more packaging, more shipping, and often more hourly labor. If output doubles, total variable cost often rises substantially as well, even if not perfectly one-for-one in every case. That makes variable costs more flexible when demand weakens, because they tend to fall as production falls. A manufacturer buying steel, cardboard, and freight services feels this very directly. For analysis, the key question is which costs truly scale with activity and which ones do not. Once you separate fixed and variable costs, volume effects become much clearer. Total fixed cost stays flat across a range of output, while total variable cost rises as more units are produced. But fixed cost per unit does not stay flat. It falls as those same fixed dollars are spread over more units. That is a major reason profits can improve quickly once a business gets past break-even. The reverse is also true. When sales are weak, high fixed costs can drag earnings down fast because the company still has to pay them. This is the beginning of operating leverage, which we will build on later in the chapter. Contribution margin tells us how much one additional sale contributes toward covering fixed costs and, after that, toward profit. The formula is simple: price per unit minus variable cost per unit. If a product sells for $50 and costs $30 in variable cost, the contribution margin is $20. That $20 does not become profit immediately if fixed costs are still uncovered. It first helps pay rent, salaries, leases, and other fixed obligations. Once fixed costs are fully covered, each additional unit contributes much more directly to profit. So a higher contribution margin means the business reaches break-even sooner and benefits more from extra volume. Break-even is the point where total revenue exactly equals total cost. At that sales level, the business is not making money, but it is not losing money either. The standard unit formula is fixed costs divided by contribution margin per unit. If fixed costs are $10,000 and each unit contributes $20, the firm breaks even at 500 units. Below that point, the company loses money because contribution margin is not yet enough to absorb fixed costs. Above it, each additional unit adds profit at roughly the contribution margin amount. A simple cost analysis process keeps the logic clean. First, classify each major cost as fixed, variable, or possibly mixed if it has both elements. Second, total the fixed costs for the relevant period, such as a month or a quarter. Third, estimate variable cost per unit so you know how much each sale contributes after direct costs. From there, calculate contribution margin and use it to find break-even volume. This sequence turns a messy list of expenses into something decision useful. It is the basic toolkit managers and investors use to connect sales assumptions to profit outcomes. The bakery example makes the math concrete. Fixed costs are $5,000 per month. Variable cost is $1.50 per loaf, and the selling price is $4. That means each loaf contributes $2.50 toward fixed costs and then profit. Divide the $5,000 of fixed cost by $2.50, and the bakery breaks even at 2,000 loaves. If it sells 3,000 loaves, the extra 1,000 loaves above break even generate $2,500 of profit. Notice that fixed costs stay at 5,000 throughout. What changes is how many loaves are available to absorb them. The same logic works for a software subscription business, even though the product is digital rather than physical. Suppose monthly fixed costs are $10,000 and each user contributes $40 after variable costs. Break even is 10,000 divided by 40, or 250 users. If the company reaches 400 users, it has 150 users above break even. At $40 of contribution margin each, that produces $6,000 of monthly profit. For investors, this is a useful reminder that variable cost can be low in software, but fixed costs still matter because they shape how quickly profit scales. Cost analysis becomes misleading when the categories are too simplistic. Some costs are mixed, such as a utility bill with a base monthly charge plus usage-based charges. Fixed costs are also only fixed within a relevant range. Once capacity is stretched, they can step up sharply. Another common mistake is confusing total fixed cost with fixed cost per unit. Total fixed cost may stay constant, while fixed cost per unit falls as volume rises. And break-even should not be treated as a victory line because it represents zero profit, not economic success. Good analysis depends on matching the assumptions to how the business actually operates. For investors, cost structure is really a lens on sales sensitivity. Fixed costs stay constant in total over a range, while variable costs rise and fall with output. Contribution margin links each sale to the process of covering fixed costs and then generating profit. AZ555 and the phone number on 55 and 77 plea powerful when volume grows. That creates both upside and downside, which is why cost structure tells you something about resilience as well as growth potential. With that foundation in place, we can move from cost categories to the broader idea of economies of scale. Section 2. Economies of scale. Economies of scale mean that as output rises, average cost per unit often falls. Total spending may still increase, because producing more usually requires more materials, labor, and logistics. The key is that cost per unit can decline even while total cost goes up. That decline can strengthen margins, improve pricing flexibility, or both. But scale is not a magic formula that works forever. After some point, the benefit usually flattens and can even reverse. Unit cost often falls for several related reasons. The most basic is that fixed costs are spread across more units, so each unit carries less overhead. Larger firms may also get better input prices through bulk buying, reducing variable cost per unit. As organizations grow, workers and managers can specialize, which often improves productivity and reduces waste. Equipment can also be used more fully, turning underused capacity into more efficient output. Put together, those forces explain why bigger production runs often lower average cost. A sandwich shop is a simple, everyday example. Whether it sells 100 sandwiches or 500, the rent and much of the kitchen equipment may be basically the same. At higher volume, each sandwich carries a smaller share of that overhead. The shop may also get lower ingredient prices by buying bread, meat, and packaging in larger quantities. Work can become more specialized too, with one person prepping ingredients while another assembles orders. The result is lower average costs per sandwich, even though the total monthly spending of the shop may be higher. Internal economies of scale come from changes inside the firm itself. A larger business may justify better machines, more automation, or systems that are too expensive for a smaller competitor. It can divide labor more effectively so people focus on narrower tasks and become faster or more skilled. Purchasing power can improve as order sizes grow, and financing may become cheaper if lenders view the larger firm as more stable. Marketing can also scale because a big campaign may support a larger revenue base. All of these advantages come from the firm's own growth, not from the surrounding industry. External economies of scale are different because the benefit comes from the growth of the industry or region, not just from one company. As an industry cluster develops, specialized suppliers often appear, making inputs easier and cheaper to source. Labor pools deepen as more workers gain relevant skills and more training programs emerge. Infrastructure such as transport, warehousing, and logistics can improve around the cluster. Shared services, consultants, and know-how also become more available. In effect, the whole ecosystem becomes more efficient, and individual firms can benefit even if they are not huge on their own. To evaluate whether scale is helping, start by separating fixed and variable costs clearly. Then look at what happens as output rises or capacity is used more fully. Compute average cost per unit at different production levels rather than focusing only on total cost. If unit cost falls as output grows, scale is creating a real efficiency benefit. If unit cost stays flat, the benefit may be limited. And if unit cost starts rising, the company may be running into diseconomies rather than economies of scale. The coffee roastery example shows the difference between total cost and unit cost very clearly. At 10,000 bags, total cost is $130,000, which works out to $13 per bag. At 20,000 bags, total cost rises to $190,000, yet cost per bag falls to $9.50. That is a drop of $3.50 per bag, or about 27%. Some of the gain comes from spreading fixed costs, and some comes from better variable economics such as bulk purchases or improved yield. For investors, this is exactly the kind of improvement that can expand margins or support more competitive pricing. Scale helps only up to a point. As firms become very large, added layers of management can slow decisions and weaken communication. Oversight becomes harder, quality can slip, and supply chains become more complex to coordinate. At that stage, average cost may stop falling and begin to rise, which is what we call diseconomies of scale. The efficient size is not simply the biggest size. It is the size where cost per unit is minimized. Investors should be careful not to assume that larger always means better. Scale and scope sound similar, but they describe different cost advantages. Scale means producing more of the same product, which lowers average cost through volume, specialization, and fixed cost spreading. Scope means producing different products together more cheaply than producing them separately. That can happen when products share distribution, technology, branding, or facilities. A beverage company using the same bottling and delivery network for multiple drink brands is benefiting from scope, not just scale. Keeping the two ideas separate helps you see where a firm's advantage is really coming from. From an investor's perspective, the question is whether growth is actually making the company more efficient. Rising total cost is not a problem by itself if unit cost is falling, but scale benefits may flatten over time, especially once easy efficiencies have already been captured. Industry structure also matters, because some sectors naturally support stronger scale effects than others. A software platform or manufacturing network may scale well, while labor-intensive services often scale less dramatically. The key is to watch for evidence that growth is still lowering unit cost rather than merely making the organization bigger. Section 3. Operating leverage. Operating leverage describes how a company's cost structure affects the way sales changes flow through to operating income. A business with high fixed costs and relatively low variable costs usually has high operating leverage. A business with low fixed costs and more variable costs usually has lower operating leverage. The reason is that fixed costs remain in place in the short run. So once they are covered, additional sales can lift profit rapidly. But the same structure also makes earnings more vulnerable when sales fall. So operating leverage is really about earning sensitivity created by the mix of fixed and variable costs. Fixed costs create a threshold effect in profit. Before a firm covers its fixed costs, contribution margin is mostly being used just to keep the business afloat. After those fixed costs are covered, a much larger share of each extra sale flows into operating income. That is why profits can rise faster than sales once a company is above break even. It is also why profits can fall faster than sales when demand weakens. Operating leverage acts like an amplifier, and the amplification is usually strongest when the firm is close to break even. The formal measure is degree of operating leverage, or DOL. It is calculated as contribution margin divided by operating income at a specific sales level. Since contribution margin equals sales minus variable costs, and operating income equals contribution margin minus fixed costs, DOL tells you how exposed earnings are to sales changes right where the firm currently stands. If DOL is 4, then a 10% change in sales implies roughly a 40% change in operating income, assuming the cost structure stays the same. That is a powerful number, but it must be interpreted carefully. It is not a permanent company trait. It changes with sales volume. The calculation process is straightforward if you do it in order. First, separate fixed costs from variable costs as accurately as possible. Second, calculate contribution margin by subtracting variable costs from sales. Third, subtract fixed costs to find operating income. Fourth, divide contribution margin by operating income to get DOL. This sequence matters because errors in the early steps carry through to the final ratio. And remember, the result only makes sense in relation to the firm's current sales level. Fast ship gives us an important boundary case. At 50,000 packages, revenue is $600,000 and variable costs are $100,000, leaving a contribution margin of $500,000. Fixed costs are also $500,000. So operating income is exactly 0. That means the company is at break even. Because DOL equals contribution margin divided by operating income, the formula would require dividing by 0, so DOL is undefined here. That is not a mistake in the math. It is a sign that sensitivity is extreme at the break-even point. Once Fastship moves above break-even, the effect becomes easier to see. At 60,000 packages, revenue rises to $720,000, and variable costs rise to $120,000. Contribution margin becomes $600,000, while fixed costs remain $500,000. Operating income is therefore $100,000, and DOL is $600,000 divided by $100,000, or 6. That means at this sales level, a 1% change in sales implies about a 6% change in operating income. The fixed cost base has not changed, so the extra volume creates rapid earnings growth. Different industries sit at different points on the operating leverage spectrum. Software, streaming, airlines, utilities, and manufacturers with expensive plants often have high fixed costs and lower marginal cost per additional unit, so their earnings can swing sharply with demand. Staffing firms, contract consulting businesses, and flexible retailers often carry lower fixed costs and more variable costs, so their profits move more gradually. High leverage usually offers more upside when sales grow, but it also brings more downside when sales weaken. Lower leverage can mean less dramatic profit expansion, but often more resilience. For investors, the important comparison is usually within an industry, not just across very different business models. CloudSync shows how operating leverage changes as a company moves farther above break-even. With fixed costs of $2 million, a price of $100 per user, and variable cost of $20, each user contributes $80. At 50,000 users, contribution margin is $4 million and operating income is $2 million, so DOL is 2. At 60,000 users, contribution margin rises to $4.8 million and operating income rises to $2.8 million, so DOL falls to about 1.71. The business is still benefiting from fixed cost leverage, but the proportional sensitivity is lower. As firms get farther above break-even, operating leverage usually becomes less extreme. The main lesson is that Dow is not constant. It is usually highest near break-even, where operating income is small relative to contribution margin. As a company moves farther above break-even and operating income grows, the same sales change tends to create a smaller percentage swing in profit. High operating leverage still brings both upside and downside, but the intensity changes with sales level. That is why two companies in the same industry can have very different earning sensitivity at the same moment. Context matters just as much as the underlying cost structure. A few mistakes are especially common here. Operating leverage is not the same as financial leverage. One comes from operating costs, the other from debt and financing. DOL should not be treated as a fixed company identity because it changes as sales and operating income change. It is also undefined exactly at break-even, which is a conceptual limitation worth remembering. Most importantly, high operating leverage magnifies losses as well as gains. For investors, that makes it a useful lens for judging both earnings potential and earnings risk. Section 4. Margins and efficiency. Margins tell us how much of each revenue dollar survives after different layers of cost are removed. Expressing those amounts as percentages makes firms easier to compare across time, products, and company size. A $10 million firm and a $100 million firm can both have an 8% net margin, even though their absolute profits are very different. Margins also help identify where efficiency is improving or deteriorating. If sales are flat but margins rise, the business is becoming more cost efficient. So margins are not just profitability measures, they are diagnostic tools. There are three main margin levels and each answers a different question. Gross margin looks at what remains after direct production costs, so it speaks to product economics. Operating margin goes further by including overhead and operating expenses, showing how efficiently the core business is run. Net margin goes all the way to the bottom line after interest, taxes, and other non-operating items. Because each margin strips out a different layer of cost, they should not be used interchangeably. A company can look strong at one level and weak at another. Gross margin focuses on production economics. The formula is revenue minus cost of goods sold divided by revenue. It tells you what share of sales is left after paying for the direct costs of making or acquiring the product, such as materials and direct labor. If gross margin improves, the cause may be lower input costs, better labor productivity, stronger pricing, or a more favorable product mix. That makes gross margin especially useful for understanding the underlying economics of the product itself. It is often the first place investors look when evaluating pricing power and production efficiency. Operating margin expands the picture from making the product to running the business. It includes cost of goods sold and also operating expenses such as selling, administration, and often research and development. The formula is operating income divided by revenue, or equivalently, revenue minus COGS minus operating expenses divided by revenue. This margin captures core business efficiency before interest and taxes. A company can have an attractive gross margin but still a weak operating margin if overhead is bloated or spending discipline is poor. That is why operating margin often reveals whether management is converting product strength into actual business efficiency. Net margin is the broadest profitability measure because it reflects what is left after all expenses are paid. The formula is net income divided by revenue. This includes the effects of operations, financing costs, taxes, and sometimes unusual items. For that reason, net margin shows the amount ultimately available to owners, but it does not isolate operating performance by itself. A firm can improve its operating efficiency and still see net margin held back by higher interest expense or a heavier tax burden. So net margin matters a lot, but it should be read alongside gross and operating margins. Efficiency widens margins because it lowers the input needed to generate a given output. If direct cost falls, gross margin improves. If overhead falls, operating margin improves. If financing costs fall, net margin improves. The important idea is that each sustainable dollar of savings raises profit at the relevant layer, even if price and sales volume do not change. A company does not always need more revenue to become more profitable. Sometimes better processes, lower waste, or smarter financing can do the job. A practical margin review starts by separating the major cost layers on the income statement. Break out COGS, operating expenses, interest, and taxes, then calculate gross operating and net margins from the current numbers. After that, identify the largest cost pools because those usually offer the greatest leverage. A small percentage improvement in a big cost category often matters more than a large improvement in a tiny one. Once changes are made, recalculate the margins and check for side effects such as lower quality, delays, or employee burnout. Good margin analysis is both numerical and operational. The clothing brand example shows how cost savings flow through the income statement. Revenue stays at $1 million because the company still sells 10,000 jackets at $100 each. Material and labor cost falls from $40 to $35 per jacket, reducing COGS by $50,000. That lifts gross profit by the same $50,000, so gross margin rises from 60% to 65%. If overhead stays flat, operating income also rises by $50,000. Moving operating margin from 25% to 30%. The lesson is simple. When savings occur in a major cost layer and revenue holds steady, margins can improve quickly. The bakery exercise helps compare savings at different layers. With $50,000 of monthly revenue and $20,000 of ingredients and packaging, gross profit is $30,000, so gross margin is 60%. After $18,000 of rent, wages, and utilities, operating profit is $12,000, giving an operating margin of 24%. If the bakery cuts COGS by $2,000, gross margin rises to 64% and operating margin rises to 28%. If instead it lowers operating expense by $1,500, gross margin stays where it was, but operating margin rises to 31%. So where the savings occurred determines which margin improves first. Cost cutting only creates real value when it removes waste without harming the business. Some cuts can damage quality, delivery reliability, customer experience, or employee morale. Others may reduce spending on maintenance, training, or innovation and create larger problems later. A temporary margin boost is not the same as sustainable efficiency. The goal is not the lowest possible cost structure, but the most effective one for delivering value. That idea leads naturally into the final section, where we think about cost optimization more strategically. Section 5. Cost optimization. Cost optimization is about spending better, not simply spending less. Traditional cost reduction asks where expenses can be cut. Cost optimization asks which spending actually creates value and which spending does not. That distinction matters because some cuts lower quality, hurt customer retention, or reduce productivity. A business can become cheaper and weaker at the same time. The real objective is the highest value cost structure, where each important dollar of spending earns its place. The starting point is to connect costs to what they support. Map the major activities in the value chain, such as acquiring customers, serving them, operating the business, and protecting the enterprise. Then link each cost to a value driver like revenue growth, quality, speed, reliability, retention, or compliance. Some spending directly drives sales, while other spending protects the business from failure or loss. Once those links are visible, it becomes easier to question costs with no clear purpose. Optimization gets much better when you ask not just what a cost is, but what it is there to do. In practice, the first round of optimization often comes from obvious waste rather than dramatic strategic cuts. Duplicated work, too many approvals, unnecessary handoffs, and overprocessing are common sources of friction. Businesses also waste money through idle labor, idle capacity, excess inventory, weak supplier terms, and outdated software. These problems raise costs without improving value. Because they are often operational rather than strategic, they can be fixed without damaging the customer proposition. That makes them a much safer starting point than broad cuts to frontline functions. Every cost decision involves trade-offs, even when the savings look attractive. A cut can improve this quarter's numbers while creating larger losses later, through defects, returns, churn, or weaker resilience. Cutting quality control might save payroll today, but increase warranty claims and damage the brand over time. Cutting customer service might lower headcount, but raise refunds and cancellations. Good optimization weighs both sides of the decision, not just the immediate expense reduction. The right question is whether the business becomes stronger after the cut, not merely cheaper. Unit economics is often the right testing ground for cost decisions. Instead of looking only at total spending, measure what changes at the level of the customer, order, unit, or transaction. A cut that saves $2 per order may look appealing until it causes $5 of lost margin through lower conversion or weaker retention. In subscription or repeat purchase businesses, lost lifetime value can easily outweigh the visible savings. That is why outcomes matter more than headline expense reduction. A cut is bad economics if it destroys more value than it saves. A structured process makes cost optimization more reliable. Start by mapping the value chain so you can see where work and spending occur. Tag each major cost to the value driver it supports. Then compare the value created with the cost incurred. Rank opportunities by how much waste they remove or how much value they preserve per dollar spent. Test changes rather than assuming they will work, and monitor the results after implementation. In other words, cost optimization is not a one-time cut. It is an analyze, test, review, and repeat cycle. Efficiency ratios can be a useful screening tool, but they require judgment. A simple version is revenue contribution divided by cost, which gives a rough sense of value created per dollar spent. Activities with low ratios may deserve review, but low does not automatically mean bad. Some costs, like cybersecurity, compliance, or preventive maintenance, may not generate obvious revenue, but still prevent major losses. That means the ratio is a prompt for investigation, not a final answer. Good decisions combine simple metrics with business context. The shipping example shows why lower unit costs can be misleading. Switching from a $15 premium carrier to a $9 budget carrier looked like a 40% savings per shipment, but the pilot group experienced 12% higher cancellations and a 25% rise in support tickets for late arrivals. Those customer effects reduce retention value, which is far more important than the $6 shipping savings by itself. In a recurring revenue model, even a small increase in churn can destroy a lot of lifetime value. So the cheaper option produced worse economics overall. Often, the strongest answer is not choosing between the expensive option and the cheapest one. Better optimization may come from redesigning the process so cost falls without hurting value. That could mean negotiating better vendor terms, reducing package weight, removing unnecessary steps, or matching capacity more closely to demand. In the shipping example, staying with the better carrier but improving the surrounding process might create real savings without damaging retention. This is why optimization is often a design problem, not just a purchasing decision. And it is also why firms should stop cutting once further savings begin to weaken the business. Poor cost decisions are usually blunt or narrow. Across-the-board cuts ignore the fact that different functions create different kinds of value. Automation is not automatically a win if setup costs, maintenance, and errors offset the savings. Many companies also ignore customer effects such as brand damage, churn, or weaker service, and some measure only expense reduction without tracking business outcomes. The investor takeaway is straightforward. Good optimization improves the economics of the business, not just the appearance of the cost line. Smarter spending, not simply lower spending, is the real goal.